We were told that, well, this is such a severe crisis. We're seeing major institutions who now have assets on their books that they thought were super duper, but now turn out to be not super duper, and therefore we need to bail them out. And if we don't bail them out, then there's going to be a terrible contagion from one bad institution to another, and it's just going to be a cascade, and there'll be a domino effect, and everything will collapse, and certainly you stupid rubes don't want that. So shut your mouths and let us formulate this bailout policy. So, for instance, I won't go through TARP. There's plenty of stuff written on that. But although I remember when the House initially voted against that, and the establishment media and people came on TV, and it was like their dog had just died. And they were talking like, they can't. Who do these rotten, upstart, uppity nobodies think they are to vote against something that their betters have told them they all need? And everybody, every respectable person, in all the financial papers, all the free market, so-called free market people, they're all saying, well, we got to make an exception. We can't be extremists here. Got to make an exception. You know, George W. Bush said, I have to suspend the free market to save the free market and all that. And that was the conventional wisdom. Paul Ryan is begging people on the House floor, oh my goodness, you got to just do whatever they say and everything's going to be terrible. They all did that. They all went for that. Except a noble few. Okay, a noble few stood up and said, nope. I don't buy it. Well, AIG, this insurance company, and in fact, it's either my wife or I, we actually have life insurance through AIG. Their insurance branch is fine. There's nothing wrong with it. And in fact, 90% of AIG was perfectly solvent. So there was no reason that AIG couldn't have just gone through normal bankruptcy proceedings. And then later, one of its former CEO of AIG came along and said, you know what, on second thought, it might have been better if AIG had just gone through bankruptcy. Now, we had all said that maybe it should just go through bankruptcy, and we were told, you are not even entitled to live in civilized society for having an opinion like that. Now, the guy comes along and says it. Well, I don't know, nobody apologized to us, but that's okay. We don't need that. But when we think, first of all, about the bailouts, remember that it's not like the amount of stuff in the economy collapsed during the crisis. The amount of stuff was the same. There was just as much lumber and steel and concrete as there was the day before. It's that people had overvalued certain assets, and it turns out their price actually should have been lower. So in bankruptcy, you will rearrange ownership titles to these various goods, but there's still just as much stuff as there was the day before. So we should bear that in mind. The stuff is the same. Well, David Stockman investigates this AIG thing in his great book, The Great Deformation, which I highly recommend. You'll love that book. It has such a punchy prose style. How can he sustain a punchy prose style for 700 pages or whatever it is? I don't know, but I just love it. I'm envious of his prose style. His prose style is like, you ever heard that Orwellian image of a boot, stepping on a human face forever? Well, I always loved that image. Well, this is the image for the Stockman book is a fist, coming through the book right at your face. And it's not really a fist. He's not trying to punch you in the face. It's just in case, like, Hank Paulson happens to be sticking around. Maybe he'll get it. But he says the problems with AIG, he says, would have been confined to Wall Street, would have fizzled out right there. So the claim that, well, we have to bail them out to save all the Main Street banks. He says, He said, no, that is not true, because almost none of the problems with AIG had anything to do with any of the Main Street banks. AIG had problems with something called its credit default swap liabilities. Well, almost none of these busted CDS liabilities were held by Main Street banks. Who was holding them? Basically about a dozen institutions. And these dozen institutions could have absorbed this hit. How do we know that? Because these dozen institutions held about $20 trillion in assets, and the losses they were going to take on this were about $60 billion. Now, that amounts to a few months' worth of bonuses. That's it. That was what was preserved by the bailout of AIG. And remember, they didn't have time even to talk to us about that. We don't even have time to listen to what you people are saying. The economy is collapsing, and if we don't supply these bonuses, if we don't bail out AIG, everything is going to, and everything's rush. We don't have time to talk to you about it. Patriot Act, too dangerous to talk to you people about this. Got to just put it through. Bailouts, we don't have time to figure out who's actually exposed to AIG. Who needs to ask that? Just fork over the dough. And that's what happened. Or we were told money market mutual funds are collapsing. So again, we need a fresh bailout. We don't have time to talk to you people about this. You stupid rubes, you're not even entitled to an opinion. And this was because the Reserve Prime Fund broke the buck, which means that it went below $1 a share. And that's a highly unusual thing. So who knows what will happen next? And so they're all taking their money out of money markets and they're putting it under their mattresses, and it's terrible. Well, it actually turns out that isn't what was happening. People were taking their money out of riskier money markets and putting it in safer money markets. And people who did on net withdraw their money from money markets, which I did, by the way, just because I just finally thought, well, why am I holding all my money in this stupid money market that earns me like $1 every 3 centuries? So I actually took mine out, did something else with it. They basically put their money right back into the banking system, either into CDs or savings accounts and whatever. Then we had the case of John Mack, who was the CEO of Morgan Stanley. And John Mack is unhappy because people are short-selling his stock. Now, not everybody's going to know about short-selling, by the way. It's sort of lingo, but short-selling is like if you think a stock is going to go up in price, you buy that stock. Because then when it goes up in price, you'll own it, and you can sell it and collect the difference. But if you think a stock is going to fall in price, you short that stock. And the way you do it is you borrow the stock at the current higher price, and then you sell it at that price and collect the dough. And then when the stock price falls, you buy it back at the lower price and then return it and keep the difference. So, for example, I borrow $100 worth of stock and I sell it for $100, and then I wait for the price to go down, goes down to $60. I buy it for $60. I return it. Meanwhile, I keep the $40. So that's shorting a stock. Well, regulators don't typically like this because stock shorting, it tends to show them up because it's a way that a firm that's in trouble or a firm that's engaged in shady practices can be exposed just by average investors. And regulators don't like being shown up, and CEOs like John Mack don't like being shorted. So it's horrifying that his stock is being shorted by these terrible people on Wall Street. But actually, what was really happening was that his customers were just withdrawing their money because they thought John Mack was kind of a knucklehead. And so he calls up Washington, his buddies in Washington, and says, you've got to stop, you've got to put a lid on short selling. And he got what he asked for. For 15 days, the rule was you can buy all the financial company stock you want, but you are not allowed to sell it. So now there is no free market institution that could enforce something like that. So this is the government obviously and repeatedly helping the wealthiest people. And again, when you're dealing with cases where the difference between the government helping them and the government not helping them is just a few months worth of bonuses, to say, well, we just need different politicians. I mean, you just want to smash, I don't know what you want to smash. I don't know, somebody's head, I don't know what you want to do. We're not violent people. But 10 years earlier, 10 years before this even happened, the Fed had sent a pretty clear signal of what it was going to do in the future. When back in 1998, the Fed arranged for a bailout of a hedge fund called Long-Term Capital Management. Now, I talked about this in Rollback, and then more recently in Stockman's book, he says this. Long-term capital management was an egregious financial train wreck that had amassed leverage ratios of 100 to 1 in order to fund giant speculative bets in currency, equity, bond, and derivatives markets around the globe. The sheer recklessness and scale of long-term capital management speculations had no parallel in American financial history. Long-term capital management stunk to high heaven and had absolutely no claim on public authority, resources, or even sympathy. And this was the hedge fund that the Fed decided, well, this thing can't be allowed to go. We have to arrange for a bailout of it. So over the next 15 months, after the bailout of long-term capital management in 1998, the S&P 500 went up by 50% in 15 months. 50% in 15 months. So did this mean that American companies were now seeing their profit outlooks increase by half? Is that what was meant by the S&P 500 going up by 50%? No, according to Stockman, what it actually means is that it showed how confident these firms were that the Fed was going to step in to prevent the usual free market punishment of firms that had made unwise decisions. So he said that these stock market averages reflected, quote, expected monetary juice from the central bank, not anticipated growth of profits from free market enterprises. So, and it wasn't just specific firms that we're talking about here that were going to benefit from the chairmanship of Alan Greenspan or his successors. Stockman talks about something he called the wealth effect. And what's meant by that is that if the Fed can manage to push stock prices higher, this will make Americans feel wealthier. They'll look at their stock portfolios and say, look at how well I'm doing. My stock prices are increasing, and this will make Americans more liable to spend and borrow. And that will stimulate economic activity. Now, that doesn't really sound like a free market approach to the economy, right? It sounds more like a planning approach. We gotta trick people into spending, and then that'll juice things up. Well, that's more or less, that was the policy. So now, if that's going to be the policy, well, that practically builds in bailouts. Because if a major firm is about to go under, or at least see its stock price fall dramatically, this is going to undermine the whole wealth effect strategy. This will bring down the stock market. This will bring down stock prices. And the wealth effect is intended to raise stock prices. So if there is some major bit of financial news, like such and such firm is going down and this firm is going down, this will undermine their whole program. So they will have to bail them out to preserve their policy of the wealth effect.